achieving a 20% risk-adjusted return is not an easy thing to do. And so you are going to be taking massive risk. And the question is, have you identified where that risk really is? Sellers want to sell at yesterday's price and buyers want to buy at tomorrow's price. And that spread in pricing can be anywhere from 5 to 25%, probably I would say 5% at the industrial and residential end of the spectrum, and 25% probably plus at the office end of the spectrum. There are undoubtedly opportunities out there. I think there are more opportunities in front of us than behind us.
Quick one from me. If you haven't already subscribed or followed this show on the podcast or app where you listen or watch, please do. It takes 10 seconds and helps tremendously. I've got really big plans for the People Property Place podcast, and that one small action really helps grow the show and the presence and enables us to keep doing what we're doing. So if you haven't already, please follow or like on the platform you watch or listen to. Thanks so much. Welcome to the People Property Place podcast. Today we are joined by Phil Irons, Managing Director and Head of Transactions, UK and Ireland at Patrizia. Patrizia is a leading partner for global investments in real assets. With over 57 billion euros of assets under management, they offer institutional and private clients a broad range of attractive investment opportunities, delivering long-term sustainable growth. Phil has over 25 years experience in the UK commercial property market, having started his career at Cushman Wakefield before moving to Benchmark Group PLC, and has held roles at Schroders, Benson, Elliot and IWG's Workplace Capital Partners, having graduated from the University of Cambridge, having studied land economy. Phil, welcome to the podcast.
Thank you.
Not at all. Well, look, I'm really excited to unpack your career, but also dive into your views and opinions on the market at the moment, because it's obviously an interesting time. But before we get onto some of that good stuff later, can you just talk to me a little bit about how and why you got into real estate?
I think I had the good fortune to fall into real estate through land economy at Cambridge. I was, in my youth, a rugby player. Land economy was a popular spot for rugby players. And, you know, when I graduated, property was the obvious place to go, really.
So no family connection?
I had some kind of tenuous family connections. My dad was a civil engineer, so worked in the construction industry. But other than that, no, just a general interest in property.
And were you particularly academic at school, or was it a case of, you know,
that's a very loaded question.
You're a good rugby player.
I was reasonably academic. I think it would be fair to say I got to Cambridge on my sporting rather than my academic ability.
Which is often the way with rugby players, right?
And there are a few, yeah.
I think a few have been on the podcast as well who've done a similar route. So you kind of went to Cambridge with rugby and sport in mind, and chose the land economy, or was that the degree that was offered to you?
It was the degree that was offered to me. But I think if I would have chosen it if I'd been given the choice. But it was a well-trodden route. And
when did it dawn on you that a career in rugby was not on the cards and a career in property was becoming a little bit more?
So when I left Cambridge, I played for London Irish for a few years, and it was in the era when the game was going professional. And I would best sum up my rugby playing ability as when they picked the first team at Irish, I was probably the 13th or 14th player on the list. You know, I was a good player, but I was, there were a lot of players who were significantly better than me. And I realized that I didn't really have a long-term future in professional rugby.
What was your position?
Blindside, flanker. But I love playing rugby. I've played team sports all my life, so it came very naturally to me.
So was that a full-time
No, so this was when I was at Cushman Wakefield, Healy and Baker as well.
So you were juggling kind of the early parts of...
And at that point, we were training, I think it was 3 or 4 times a week. So it was a juggle between that. But Cushman's were fantastic at the time to give me the flexibility to do both.
And was that the standard route when you left university, going into one of the advisory businesses to get your letters?
Yes.
Rather than moving straight to the principal side?
Yeah.
And did you do some rotations, or what did that look like?
So when I joined Cushman's, they had a rotation program, but because I was in the Central London investment team, it was felt you got sufficient experience across all the relevant sectors that we didn't rotate. So then that worked really well for me.
And that you found was a good fit in terms of your personality, your kind of technical or academic background?
Yeah, exactly. And I like the investment side of the business had always been my primary focus rather than the straight agency. I was there for just over 2 years. I enjoyed it, but felt that the agency side of the business was just a bit too transitory. That my involvement in a deal, being involved on whether it was on a buy side or a sell side, was just I wanted greater involvement over the duration of a deal's life, really,
rather than just finding it and placing the deal. You just wanted more control over the business plan and the execution of it. Yeah. And how did you decide, or how did that role or that move away from Cushman Wakefield, how did that come about?
I got approached, but given my Central London experience, I got approached by Benchmark, which was a small listed property company at the time. It was too exciting an opportunity to pass up. And I spent almost, I think it was 8 years there working with Nigel Kempner. I was really, really fortunate. I had a fantastic time, really enjoyed it. Did a lot of deals. I think when I joined, the company had a NAV of, I think, about 250 million. And when I left, we had an NAV of 1.2 billion or so. So we grew substantially over the time period. And
what assets were you looking at? And what was
it was
the risk
typically
profile?
Central London offices with some typically retail on ground floor. So it was ancillary retail. Risk profile was listed propcos at the time, which I would say today is the equivalent of it was a precursor to GPE. So it was a similar sort of value add / opportunistic risk profile.
But it was listed.
A listed
one of
vehicle.
The early listed
earlier
entities?
So at the time, the competition was for Central London. The Central London listed space was us and Derwent, and GP, but GP at that time were not. They had a London exposure, but it was a pan UK portfolio as a whole. They only became specialist Central London players probably 20 years later.
Yeah. And so your role, you literally took your experience in terms of being a Central London investment agent, flipped it to being on the principal side, and then leveraging your network and connections on the advisory side that you built up.
Exactly.
Started saying, I'm the guy with the money now.
Yeah.
You started getting wined and dined rather than the other way around. 8
very good years at Benchmark, yeah.
And how did your role evolve? Because did you kind of go in there as an investment manager? Was that kind of the title?
I was a transaction manager working with or for Nigel Kempner. Nigel typically would source the deal and I would then implement the transaction. Yeah,
because that's quite an interesting distinction you touch on there between investment manager and transaction manager. So can you just talk about what that difference is and what an actual, what part of, so investment manager sourcing the deals and finding them.
We had an internal asset management team who would be involved in the underwriting of the purchase and who I would then hand the asset over to post completion of the purchase. And I would be involved from a distance in terms of tracking the deal's performance and then get involved when we felt we were close to an exit.
So it was more high level.
It was higher level. I sat in weekly asset management meetings, that sort of thing, and would track the deal and then would make recommendations as to when I felt was the right time to sell.
And as part of your role as a transaction manager, do you work closely with the investment manager, but your role was more debt sourcing, structuring?
I suppose from investment manager, I would read asset manager.
Yeah.
So we, it was an open plan office. We worked together. It was pretty, it was a regular discussion between the relevant parties.
And your role just evolved as you got a bit more experienced and more capable, running more work streams and taking a lead in terms of more projects.
Exactly.
So you were there for, shy of 7 years, leaving or as head of transactions. Can you just talk to me about the move to Schroders and how that came about and why?
In my last few years at Benchmark, we set up a joint venture with Schroders, the Wellput it was called, which was the West End of London Property Unit Trust, which was an office portfolio that we had seeded with Benchmark assets. We brought Schroders in to manage it and raise third-party capital. And that ran for probably my last 2 or 3 years at Benchmark. And as that, the portfolio, we're now going back to 2002 to 2004, so post.com, the Benchmark's performance on the listed sector had not been good, so it was taken private and sold to GE Capital. Because I'd done the deal with Schroders, they approached me about coming to run the transaction team for them. Having only ever done central London investment at that point, I was quite keen to diversify my career out of London, and working at Schroders was a great opportunity to do that.
And so Schroders, big fund management business.
Huge, UK institutional fund management business. With the benefit of hindsight, I didn't realize at the time that actually investing just core capital, which is all Schroders had at the time, was actually quite dull. Targeting 6 to 8% total returns, buying, long income type deals, didn't require a huge degree of thought in terms of an underwrite. And so I spent 2 years there. I was lucky I worked with William Hill. William was a great guy. I really enjoyed my time there, but ultimately the risk profile of the deals we were doing was just a little bit too vanilla for my liking.
And what type, did that expand into kind of the regions or different asset classes?
So it was moving away from London offices into industrial, into the regional office markets, retail. So it was interesting from a sector perspective, but not a risk profile perspective.
And so you were buying fully let, fully developed, kind of more shiny,
income-producing
assets
exactly.
that you could sit on that had an RPI inflation linked.
RPI or kind of open market,
link. And so you just buying them. And as you said, it became a little bit monotonous.
Yes.
Or it wasn't quite as exciting.
It wasn't quite as exciting. And so I did 2 years at Schroders, and was then fortunate to be approached by Mark Mogul at Benson Elliot. He was in the process of setting up a pan-European private equity real estate fund management business, and I was brought in to run the UK arm of that, which I did for I think about 8 years. That was at the kind of other end of the risk spectrum, truly opportunistic, typically 20% gross ungeared type target returns. I did that, as I said, for 8 years. We raised 2 funds, and I learned a vast amount. Having come from a chartered surveyor type background to join a private equity business where all your colleagues are investment bankers is interesting.
Must have been like your time being a rugby boy going to Cambridge, right? Been there and done it before.
It was. Yeah, I learned a vast amount.
Can you just elaborate on that and what you mean specifically by that? Because there'll be some people who listen to this who go, what do you actually mean? Kind of, you're a qualified surveyor, you went to Cambridge, you've been doing deals. Yes, you're in a kind of a bigger UK institution at Schroders. Going to Benson, Elliot, where you touch on bankers and financial engineers. Like, what do you mean by the environment there and the mindset when it comes to real estate? Because
the level of professionalism you get from investment bankers is I think a class above what you typically get from your average surveyor. And that's not to do down the surveying industry in any way, shape or form, but just the quality of the work undertaken by former investment bankers generally seems to be of a higher standard. Whether the results of the work they do in terms of the way they underwrite deals is correct, and their performance is as strong as they would have you believe is another question altogether. But the thoroughness of their approach to it is second to none.
And the context is probably important here, because typically it was, back of a fag pack analysis underwrite, and it was more of a kind of a gut feel type play with your surveyor hat on, right?
I think that's fair, yeah. Whereas
the banking side
was a level of modelling that I had up until that point never come across.
And financial engineering and structuring from a tax and efficiency perspective, just to try and make your money go
really
further.
Squeeze your returns, yeah. And that was absolutely fascinating. But ultimately, you can financial engineer to your heart's content, but it's really about the real estate that you're buying. And
so, what did they see in you at the time in terms of plucking you out of a UK core institution to a bit more of a higher octane?
Mark's view was at the time, and I think still is, that actually, if you're looking to source, I'm not sure if it still is the case today, but if you were looking to source opportunities, being English and being a surveyor is you have a huge network of contacts through, from my time at Cushman Wakefield and Benchmark. That level of connection with the market enables you to source opportunities that your traditional investment banker might struggle to do. And
so combining your network and ability to originate deals with their financial underwrite structuring, there's a play there.
There is, definitely. There is a definite place there. Yeah, but getting to grips with financial modelling was really hard. But and that took a few years. But I definitely think I got there.
And in terms of the funds itself, you touched on 20% geared IRRs, very different to core cash only.
Yeah, quite literally the other end of the spectrum. Yeah. And
so, what types of assets were you investing in at the time?
Typically, we were taking we were definitely taking capex risk, and quite often we were taking planning risk. Possibly not. Yeah, I think I would say those were the two key drivers. So we were buying, if a core investment deal is long income, well let with no capex or planning risk. Opportunistic is short income / VP, large capex risk and potential planning risk in terms of extending an existing building or something like that.
And so you were operating at that level with a view to implement a business plan and create a core asset that you could have sold to your old shop, Schroders,
and
to square that circle. That you would have been looking to kind of buy at Schroders kit that you went on to go and do at Benson.
Was fully core. Yeah.
And what were the typical sizes of the assets that you were investing in?
We raised so the first fund we raised at Benson Elliot was 250 million of equity. So our typical minimum deal size was probably, in equity terms, 20 million up to potentially 50 million, but it would be potentially larger if it was a portfolio deal and there was some diversification in the portfolio. Yeah.
And your role, as you said, how did that evolve over the kind of 9 years?
And then the interesting thing about my role at Benson Elliot was I ran the the UK team, and my responsibility was from acquisition, asset management, all the way through to disposal.
So the full piece.
The full piece, which was fantastic experience. And I'm not sure if those sorts of positions are available today, or because I think as the market has got, as fund managers have got larger, as is the case with Patrizia, you need to differentiate between transaction management and asset management, and fund management to a degree.
Yeah, because it's normally parceled. It's people work closely in teams, but the deals are passed over, right? Whereas there, if you bought the deal,
if you originated it, you stayed with it. It was your baby till you got out of it, and that made you think long and hard about the deals that you did, and certainly the partners that you worked with. But I was lucky; I worked with some great partners at Benson. We had the ability to either manage in-house or manage externally through third-party asset managers, and on the whole, we joint ventured deals with asset managers. So I did deals with the likes of XLB, Stanhope, Cube. It was a pretty varied bunch, but all great partners.
And would you personally originate the deals and then bring in an operating partner? Or
it worked both ways. Sometimes I would originate, sometimes they would bring deals to me.
And you would make sure that there's an alignment of interest with them in terms of they co-invest in the deal as well.
Yeah, exactly. Yeah.
And in terms of the business plans, were they kind of 3-5 year?
Going back to the co-investment point, it's interesting. We had a fund requirement of sorts that there was co-investment. The reality on the co-investment, though, is it's more an emotional co-investment. You've got to be happy with your partner. This is going to be anywhere from a 3 to a 7 year deal. You've got to get on with these people and you've got to work well with them. So actually financial co-investment was, I don't think as it would be a prerequisite today, but it was at the time. It's more about knowing your partner's going to go the distance with you.
But it's also the alignment of interest with them, knowing that they're going to be doing the right thing.
But if you pick the right partner, the financial alignment of interest is I don't think is critical.
Is that because, as the ultimate principle, you'll be making the decision one way or another?
Yes, there's the control element to it, but also just it's about working with the right people. And if you've got a problem, you work at it together. It doesn't suddenly, you do. The sort of partners I like to think that I worked with were not the sort of partners who would walk away from a deal if something got a little bit difficult.
Yeah.
And yeah, that was one of the key lessons I learned during my time at Benson, Elliot.
Someone listening to this who's going, that's all well and good working with partners or doing it yourself. They might say, well, why don't you just do it yourself all the time? Because surely there's fees out the door. What is the benefit of bringing in a partner, just for someone listening to this, as to why you might want to do it?
If they had a level of expertise in a market that you couldn't and weren't likely to get in the short to medium term, Stanhope on Station Hill being a good example. Station Hill was a circa 7-acre site in the centre of Reading, right opposite the station, that we bought in 2000 and I think it was 11 in a joint venture with Stanhope. The site had been pieced together by Sir John Medeski at a total cost of about 75 million. We were fortunate to be able to buy it off the banks for 7.5 million.
Wow.
And, again, we had the good fortune to sell it 5 years later for, I think it was 35 million.
To Lincoln and MGT.
Exactly.
Who have got a massive master plan. And
they do. It's a huge scheme and it's a great site.
That's an example. And Cube, you worked with Cube. You touched on Cube.
Yeah.
You did some retail.
Yeah, we did
some
retail deals with them, and we did some office deals with
XLB.
With XLB, as the company grew, we had the ability that as Benson Elliot grew, we had the ability to increase our headcount and effectively internalize some of that management. But we also had a development manager because he was managing a development portfolio across Europe. Having him full time on one job wasn't really an option. So again, outsourcing the development element of what we were doing was the right thing to do at the time.
So you could buy capacity, buy expertise. Yeah. You could have a higher view over more projects and kind of place the money
and deploy the capital.
Yeah.
That much quicker, which from a private equity perspective was a key part of what we were trying to do.
And in terms of the structure as well, at a personal level, without getting into the specifics of it, typically it's base salary, bonuses, and then a promote and an LTIP.
Yeah.
Can you just talk about that, or because a lot of emphasis gets put on LTIPs, right, within real estate private equity.
The LTIPs in private equity primarily come in the form of promotes or carries, and I think that the thing I have learnt over the years is that and my rough rule of thumb on this, as a joint venture partner to a private equity fund, if you can get in and out of a deal in 3 years, you will do very well. As long as there isn't a minimum multiple floor on your carry, and it's a straight incentivization based on IRR. If you can get out of a deal in 3 years, you'll make good money. That's as a JV partner. At a fund level, you'll make a great promote if you can get in and out of a fund in 5 years, and none of the deals in that fund tank or a kind of equity wipeout.
Which is the key piece.
Which is a key piece. The issue you've got is that most funds typically, for as brilliant as the people are who are involved, will have one or two deals that don't perform, and also one or two deals that take longer to deliver than as underwritten. And typically they underwrite to a 5-year business plan. So the reality is you're doing well to be out of a fund in totality in 7 years. The fee dilution from the fund management and asset management fees over a 5 to 7 year period can almost wipe out your promote. So we'd be banking my promote until it had been paid, because these things have a nasty habit of disappearing in front of your eyes when you go from a 5-year fund to a 7-year fund.
Can you just talk about the importance of IRR? What is an IRR? And can you just talk about it being kicked down and the importance of it coming in, as you said, within 3 years? Just for someone who's listening to this, just trying to piece together or understand this.
So
the
IRR is the total return achieved on an investment over a time period, and the equity multiple is the profit made relative to the equity invested. And the typical private equity model is looking to achieve a 2 times equity multiple and an IRR of 15% plus. The way compounding works is that effectively means that your average hold period is 5 years. So they would look to achieve, and that would be a 15% IRR net of fees. So the reality is the gross IRR before you deduct asset management fees is typically near a 20% IRR. And I think that the thing to remember about a 20% IRR is, at the time, interest rates over the period at which I was at Benson Elliot effectively dropped to almost zero. So you're looking to achieve 20% returns in a almost zero interest rate environment, which fundamentally means you are taking massive risk. And the question is, do you know where that risk is? Because people don't, achieving a 20% risk-adjusted return is not an easy thing to do. And so you are going to be taking massive risk. And the question is, have you identified where that risk really is? Is it in the capex? Is it in the lease up? Is it in the planning? Or have you simply over-egged your exit value and you've effectively backloaded the returns by putting in your exit yield?
And so the IRR is the time it takes.
The IRR is effectively the total return over a whole period adjusted for the length of that whole period.
And so when you touched on earlier, if a business plan gets kicked from 5 to 7 years, and you have a couple of deals in a wider fund, even though I don't know, the fund's got 20 assets in it, even though 18 have smashed it out of the park. The final two, if you can't exit them, you can't exit them at an accretive price, and they drag. That's going to bring your total return down.
Exactly.
And then your promote or your payment or your carry is a kicker over and above an achieved milestone.
Typically, it's very fund specific. But if the fund was looking to achieve a 20% gross return, which was a 15% net return, the fund would normally get promoted at anywhere from an 8 to a 12% IRR. So effectively, they were in the money anywhere north of 8 to 12%. Whereas the JV partner was typically being promoted over a 15, so there was an arbitrage there.
Yeah, and then you'd split it out to 80-20 or whatever it might be.
Yeah. And typically the PE model is 20% of a max carry of 20% of the profit. So, when you look at the maths, you can see how some of these deals, as I said, if you can get out in 3 years, you're making if a fund can get out in 3 years, they're making a mind-blowing amount of money. The JV partner can get out in 3 years, he's making a lot of money. Where life gets difficult is when the whole period gets extended from 5 to 7 years. Beyond 5, the JV partners, to be blunt, getting nothing other than their asset management fee. And between 5 and 7, as a fund manager, your position is being eroded by the day.
And then when it comes back to a personal perspective, obviously the company and the fund performance has got to do well for that money, that cash to be able to filter through to the investment, asset management, fund management professionals on the ground, which make up their kind of carry or relative or promote part as part of their remuneration structure. And
there is also going to work for a private equity firm. You need to realize that you are very well paid, but you're very well paid for a reason. That's because they expect you to work very long hours. Because
they want to do twice as much work in half the period of time that other people are doing.
Exactly. When it comes back to the whole time thing, if time is money, then you need to get these things done as quickly as possible. So if you've got to work longer hours, you've just got to work longer hours. So
you were at Benson Elliot from 2006 to December 2014. Right, the kind of the middle third of that, as it were, global financial crash. Surely a very challenging time, but also, given the structure of the business, a phenomenal opportunity as well in terms of second funds or vintages.
Yeah, potentially. But the thing you need to realize is that if you, so our first fund we raised in 06-07. The GFC was kind of 08 through to 10. So our challenge with our first fund is we had deployed, I don't know the numbers off by heart, but let's just assume we'd deployed 50% of the money pre the GFC.
Yeah.
Going back to what we were saying about the cash drag of non-performance, actually it meant that 50% of your fund wasn't going to hit your carry hurdle. Therefore, the other 50% to hit a carry hurdle then had to achieve twice what it was achieving before, or what you'd previously underwritten. So it is that the drag of an underperforming portfolio is potentially huge.
Yeah.
When it comes to your promote.
But the second fund,
was clean fund. We were legacy light in terms of we had no deals done prior to the GFC, and that fund performed very well
because it was a great buying opportunity.
It was a great buying opportunity, but buying opportunities are great with the benefit of hindsight. again, I don't have the stats to hand, but our second fund was, I think, 350 million euros. We did, I'm trying to think of the deals we did. We did Station Hill, we did Ealing, we did another one, an office deal in Ealing. So we did some deals that did perform really well, but like all these things, if you're looking to achieve 20% returns and you are taking construction development, planning risk, these are all areas, certainly planning, where life can get very difficult and your whole period can be rapidly extended.
You left Benson Elliot end of 2014 and you moved to Workplace Capital Partners. Can you just, who are Workplace Capital Partners and how did that come about?
So Workplace Capital Partners was a wholly owned subsidiary of IWG, being Regis, as was a majority owned by Mark Dixon, publicly listed. I'd actually spent a year after Benson Elliot trying to raise my own fund. That was mentally and physically hard. I had a good track record. I was reasonably well connected in the market, but raising discretionary capital is something I have a huge amount of respect for. And I spent 12 months trying to do it, working with 2 other colleagues. And after 12 months, one of the people I approached was Mark Dixon at IWG, and Mark actually said, "Why don't you come and raise a fund for us?" And the business plan was to raise third-party capital with a view to buying flex office, buying into the flex office market. And that was either in the form of buying existing operators, vacant buildings, or buildings where IWG were already a tenant.
Yeah.
Great idea. And Mark is the founding father of the flex office market. And I spent 4 years at IWG building a circa £250 million portfolio. But the flex market is a highly competitive market, and it's ultimately difficult to deliver returns over and above the market because of the level of competition.
Yeah. And so the idea was Mark had made a significant amount of money personally through his through Regis and IWG, and he wanted to still operate the assets, but he also wanted a piece of the actual real estate.
He wanted to own. It was a freehold owning
and the opco, so we could make money on both sides and raise additional capital to own the real estate.
We initially, when I joined, we went out on a blind fund basis to a number of institutional investors, including shareholders in IWG, and this is back in 2015, I think it was, 2015, 16. And we had Morgan Stanley as our placement agents. And, even with that firepower behind us, getting investors over the line on a discretionary blind fund was very difficult, to the point that, the feedback ultimately was, "We love the idea of you guys owning and operating, but can you prove to us that you can actually do it?" So I then spent the next 2 to 3 years, investing in operating businesses, as I said, VP office deals and existing IWG buildings where they were in occupation. And that went well, but then, unfortunately, we got hit by COVID in, I think it's 2019, 20. And, one of the things I had learned from our first round of equity raising was, when you spoke to investors about kind of the short-term nature of the income you get with flex, that they wanted to understand how we'd performed during the GFC. And IWG's performance during the GFC, they took a significant hit, and it took them probably 4 years to get back to an EBITDA level akin to where they were prior to the GFC. And then when COVID hit, I thought, I've been here 4 years. We've successfully deployed circa 250 million of capital into the business. But I felt that COVID was going to, from an investor perspective, was going to result in the same questions about the GFC going, okay, so we understand that you've been hit by COVID, show us your performance.
Yeah.
And it was going to take us, at the time, I felt at least 18 to 24 months to come out the other side of COVID. And I was very fortunate at the time to have been approached by Patrizia, who were looking for someone to run the UK transaction or UK and Ireland transaction team. And
it was an opportunity too good to turn down.
Yeah, it was a great opportunity. Patrizia, as you've said, we're a big institutional pan-European real estate fund manager. We have circa 55 billion of assets under management. We manage we've got kind of 80 individual funds. We've got 30 odd advisory mandates. So we have a range of capital from core through to value add. And so from a return perspective, that's anywhere from kind of typically 6 to 15% IRRs. And it's that diversity of capital that from a property investment perspective, I thought was really interesting. I suppose the diversity of capital and also the significant AUM giving us great recurring fee revenues. So that was all a real interest to me. And then that combined with a hugely positive corporate culture, I think was just made the right call. And I have to say, I've been there almost 4 years. It's a great place to work. I really enjoy it. I've got a great team. And we've got, I think, a really good culture.
And so that kind of journey of working in advisory to UK sleepy kind of core fund management business to kind of real high octane private
I think
equity.
Schroders might take offense at that, but I know what you mean.
Through to trying to set up your own business and realizing the challenges of being a solo or a small group, through to working obviously with IWG. The opportunity to join a massive blue chip fund management business with a lot of, as you touched on, recurring revenue streams from asset management mandates, and also pots of capital to go and deploy, meant that depending on the market cycle and
you could
where
be
it was
active,
hot, you could be active.
You can
on
be
all
active
sides.
Pretty much at any point in the cycle, and having that diversity of cost of capital also is kind of mentally challenging. Investing, looking at the kind of upper end of the risk curve and the lower end of the risk curve just means you're always in the market for almost every conceivable opportunity.
And so, can you just talk about the funds or the specific funds that are allocated to the UK and what you've been investing in over the last few years? Like where and how
we have, as I said, we have some local authority pension fund mandates that are, and I'd rather not name them specifically, but they typically look for a 6 to 7% total return, with a strong percentage of that total return coming through income. So looking for long income type deals. They've also been active in the multifamily sector. We have other discretionary capital, core capital, looking specifically at residential. So that those we've been very active in those elements of the market. On the core plus side, we have a number of vehicles, the Hanover Property Unit Trust being one, which is a balanced UK fund. The core plus money tends to look at slightly shorter income deals with potentially more leasing risk and relatively minimal capex risk. Those funds have been active buying. We bought Dublin offices, low capex Dublin offices. We've been buying multi-let industrial, and we've been buying some residential as well for those funds. And then kind of moving further up the risk curve, we've got a number of vehicles, the Trans-European Value Add Series being one. We had which is a value add pan-European vehicle, again, returns in the mid-late teens. They've been buying a lot of last mile development opportunities in Greater London. In fact, so much so we set up a separate sidecar for that fund called Project Urban, and we raised circa 500 million of capital, which we have pretty successfully deployed over the last 2 years. That market has seen substantial rental growth, and I think it's just a really interesting area to be playing in. So we've got everything from core through to value add, playing in the industrial, office, residential, and to a lesser degree over the last few years, the retail market. So it's a very diversified.
As well as the living space as well.
Yeah, the whole residential PBSA, we've been active in those sectors as well.
And as a business, you can either do the deals directly yourself and asset manage them through to completion, or work with operating partners and JV partners as well, right?
The JV partner option at Patrizia is specific to certain funds. So our Trans-European fund series and we also have some discretionary Korean institutional capital we invested. That is more value add focused. They can joint venture. For some of our more core institutional, whether it's our core institutional German money or our UK local authority money, they typically don't joint venture, and also the returns they're looking to achieve, more kind of 6 to 7%, don't really have the profit in them to pay third-party fees to.
And in terms of your team, you're responsible for being market-facing, finding, originating, structuring, and executing transactions.
Yeah, on the buy and the sell side. On behalf of the funds that we manage.
Yeah. And those funds, do they have a variety of, obviously we touched about the risk return profiles, I guess time horizons as well, in terms of, 3-5 years.
Yeah,
but
typically
also
the more core the fund, the longer the underwritten hold period, and the more opportunistic or value add, the shorter the hold period. Going back to our whole debate about IRR and the time weighting of it.
In terms of the type of capital, or where do you see the opportunity at the moment? Because there's quite a lot of talk at MIPIM about, core money being on the side at the moment.
Yeah, our core capital is reasonably quiet at the moment. That said, we are in the process of doing a long income hotel deal for one of our core funds. I think the opportunities today are definitely in the value end or value add end or opportunistic end of the spectrum. The challenge in the market today is the bid offer spread between, sellers want to sell at yesterday's price and buyers want to buy at tomorrow's price, and that spread in pricing can be anywhere from 5 to 25%. Probably I would say 5% at the industrial and residential end of the spectrum, and 25% probably plus at the office end of the spectrum. And from a transaction perspective, the challenge is not only identifying the asset, but identifying the vendor who is sufficiently motivated that they will bridge that gap between the bid-offer spread, and whether that's because the bank is breathing down their neck, so they have to liquidate their position. Whatever the situation, you have to be picking the right vendor.
Or they've held the asset past their...
Yeah, people who... Well, the other way of looking at it is you have to be talking to people who have to sell, not people who want to sell, because the pain they are going to have to take relative to peak valuation or the price they paid for it is going to be painful. Ultimately, the market is down 25% from June 22. Dependent on which sector you are, it can be even worse than that. I think offices are comfortably 30% plus. Retail, interestingly, less so, but retail, I think, took a lot of the pain prior to June 22. So there are undoubtedly opportunities out there. I think there are more opportunities in front of us than behind us.
So in terms of, no one wants to catch falling knives, do you think we're kind of at the bottom of that kind of J curve on the way back up, or where are we in terms of that?
Again, you have to get sector specific on that. If transactional activity is anything to go by, the whole beds and sheds market, there seems to be a consensus that the market has bottomed out. Yields are as soft as they're going to get. But in both the beds and the sheds market, you've got the critical thing for those markets is you've got occupational liquidity and rental growth, which is driving investor sentiment. The same can't be said for the retail and office market. But if you look at the London office market, certainly at the grade A end of the spectrum, the new builds, the rents being achieved are showing substantial rental growth. So you have to feel it is only a matter of time before we start to see improving liquidity in those markets.
And so it's really important right now to buy and pick your stock correctly now for this next cycle.
For this next cycle, definitely.
You touched on earlier in our conversation, big lifelong sports fan, rugby player. Can you talk to me a little bit about some of the lessons you learned on the rugby pitch that you maybe applied to kind of building high-performing teams as well?
I think building a high-performing team, for me, there are three key elements to that. The first, as we've said, is teamwork. I've spent my life playing sport. I still play sport. Teamwork teaches you, and I think rugby's a great analogy for that people can be they can be every shape and size, and everyone has a position on the field, whether you're short and fat and you play in the front row, or you're tall and quick and you play on the wing. There's a position for everybody, and I think that is so true in a team, and it's about having a diversity of thought and an approach to things. So teamwork is the life and blood of it. And personally, I believe that you should lead by example. You can't expect your team to do things you're not prepared to do, and that's hugely important to me. And I suppose the other element to it is that you have to. The third and final element is, I think you've got to be positive. You've got to focus on the positive things in life, because you can spend your life being miserable. But I think being in property makes you naturally optimistic. And I think a combination of those three creates a positive corporate culture. And having worked in places where I felt that the corporate culture was less than positive, it's very easy to get out of bed if you have the right corporate culture. If you don't, it can be quite difficult.
What do you look for, or what, in your experience, is a differentiator between a high-performing investment professional and someone who's a standard or a mediocre investment professional? Like, what are the kind of the key points or the differentiating aspects that make someone a high performer? Or
I think I've also always been of the view that you can always get better at your job, and it's that desire to constantly improve. And if something I've said to the team is, when we are in a slow market, which is what we have today, I think it is really, really important that you identify an element of your role where there is room for improvement, and you explicitly focus on that element to it. When transaction volumes are low, and that was something that I did when I was at Benson. I spent the first deal I did at BE was in 2010, having joined in 2007. So I had 3 years of not doing a deal, which is emotionally hard. But what that did enable me to do was to become financially numerate to a level that I had never achieved as a surveyor. And that is a skill that has lasted for me ever since. And so, yeah, my view is you always have to get better, and it's those people that are constantly challenging themselves to get better is a key element of the sort of people I look for in our team.
It's interesting you touched on the fact that it took you a couple of years to do your first deal, because a lot of investment professionals think about deal volume as their currency and their worth, really. And we get a lot of calls saying, "Oh, I'm in a shop," or money's tight, or we're not doing deals. I need to move to a shop that's got capital and doing deals. But it must be reassuring for people to hear that actually, you can be in a business and there is still an opportunity to kind of grow and develop. And even if you're not physically transacting, there are still things you can do to get better. I guess to a point, of course.
Yeah, nothing beats deal experience, but when you're not doing deals, there are plenty of other things you can get better at, and it's that desire. As I said, it's that desire to improve that is, I think, really important, and is the differentiator between the good and the ordinary.
You touched on financial modelling. Is that the key, or one of the key skills that you see people need to build if they want to pursue a career in real estate, private equity? Yeah,
understanding on the investment side of property, I think understanding one of the things I work with my team on is when we're analysing a deal and we're running a sensitivity analysis on a deal. The first question I will ask is, almost before once we plug the deal into a model, and we'll be then sensitizing it. And when I say, what's going to happen to the IRR if we reduce the our ERV on lease up by 5%? And my question is, I want you to work it out in your head, and it can be done, and it's not that difficult. But it's that ability, because when someone is able to do it in their head, they understand the model. Whereas that kind of type it in, computer says the answer is 25. Well, no, it's not. The answer shouldn't be 25. It should be about 18. And it's that ability to understand the numbers that is what I try and get my team to do every day.
And then blend that with your wider property knowledge, where yields are going.
Exactly.
And then suddenly you get a feel for a deal that looks right, that doesn't look right, or something's wrong. It's
something is wrong.
Gut feel.
When someone says I can't think of anything, your average cash over the whole period is 7%, and you're going, well, I don't think it is, because if you look at the cost of debt and the initial yield on that deal, your cash on cash is not going to be 7%.
Yeah.
And it's that ability to spot the mistakes early. I mean, don't get me wrong, I am no modeling genius. I can't build the cash flow models that most of my team can build, but what I can do is spot their mistakes.
Yeah.
And that is something, with the whole AI, growth in AI, and we're currently trialing an AI modeling package. The value add going forward is not going to be your ability to build the model. It's going to be your ability to spot the mistakes in the model.
Yeah. And lay on that additional context that you get from having 25 years of real estate investment management experience.
Not even 25 years. I think half the skill is knowing, is being able to spot these mistakes. It's I love doing it. It's interesting, really interesting.
Well, you wouldn't be doing what you do so well if you didn't. You are as well as a sportsman. You've got 4 kids.
Yeah.
How have you balanced being a husband, dad, and a career in real estate, investment management, and private equity? Because how
have I managed that? Obviously, by having a brilliant wife. But in addition to that, I think corporate culture is key. These things are possible if you have a work environment that is flexible and understanding. And if you don't, life is extremely difficult. So for me, it comes back to corporate culture. And that's something that I say to guys in the team. I think it's really important at some point in your career, you work somewhere that is extremely demanding and corporately difficult, as a challenging corporate culture, because it is only when you do that that you will understand what really matters to you in life. And being paid a vast amount of money to work in a private equity type or whatever corporate culture is an interesting thing to do, because it puts life in perspective.
A question that I ask everyone who comes on the podcast as we draw this to a close is, if I gave you £500 million worth of capital, who are the people, what property, and which place would you look to deploy that capital?
So my question back to your question would be, what's my target return on the capital you're asking me to deploy? If it is core plus money, looking for a 6-8% type return, I would be investing it in, I think, the industrial market, because of its occupational liquidity is a pretty good place to go. If you can buy in the 5s to 6s, get kind of 3% per annum rental growth, I think would be a good place to put some core capital. I think the multifamily and single family housing, because of the supply constrained nature of the UK residential market, again, is not a bad place to go. Slight concern possibly being your gross to net leakage on your income. But I think the rental growth there, again, is probably going to be somewhere in the 3 to 5% mark. And with 5% rental growth, pretty much anything is possible. So that's at the more core end of the market, the kind of value add opportunistic. On the value add side, I think the multi-let industrial space, again, is interesting, but you're just moving a little bit further north outside of the southeast to get those enhanced returns. And I think if I had, genuinely opportunistic capital, it would be in the office market, London offices. I think there are going to be some great opportunities there. I don't think we're there yet. I think, if you're really brave, you might go into the regional office development refurbishment game, but making the numbers stack up regionally is really, really tough. And we're going to have to see some substantial rental growth, given where capex is for refurbs today, over the next few years before we see any activity in that market. So, yeah, if I was deploying it on an opportunistic basis, I'd probably go more in the office sector, and I'd probably do a few shopping centres as well. I think town centre shopping centres, rents seem to have rebased. We're seeing a little bit of positive rental growth there. They're underpinned by alternative uses, primarily residential. Securing that residential, I think, is harder than a lot of people anticipate. But again, I think great recurring revenue town centres, I think, would be an interesting play for 15% type money. But the but being on the shopping centre side, that your hold period could, you could underwrite to a 5, but given the complexities with planning and vacant possession, there's a distinct possibility you could be in those deals for 7 to 10 years. But I do believe that they'll produce a solid income return with some potential planning upside. I
think you're the first person in the 60 plus episodes that I've done this who's broken it down into the different buckets of capital and risk return profiles.
Okay, maybe that's a function of what I do.
And I'm not surprised that you have done it, and I'm very surprised that people earlier on the journey haven't done it. But Phil, you've had a phenomenal background, career, experience, and I know I've learned an awful lot from talking to you, and I know that people listening to this will as well, in terms of the environments and the moves and the reasons and the why you've done what you've done. So I'm really excited to see what you and the team go on to do as you navigate this relatively interesting very interesting market. It rings true with what someone told me at MIPIM in terms of where the opportunities are. And we didn't touch on it, but the 3 L's: lending, living, and logistics.
Yeah.
So
the lending market I think is interesting. I think it's going to be a difficult market to deploy a significant amount of money into. Certainly if you're looking for double-digit type returns, 12 to 14%, I think it could be tough, because you're going to be forced into the mezz sector of the market, and mezz deal sizes are typically 0 to 5 rather than 5 to 15 million. So you're going to have to be doing a lot of deals to get the money out the door. So I think that market, and it's a highly competitive market, that could be it could be difficult to just get the capital deployed sufficiently quickly. But yeah, another interesting part of the market, definitely.
Cool. Well, look, thank you so much for joining me. I've
Pleasure,
really
Matt.
enjoyed the conversation.
Yeah, it's been fun. I've enjoyed it. Thanks a lot.
Thanks for listening to this week's episode of the People, Property, Place podcast. If you found it insightful, feel free to share it with a friend or colleague. Give us a rating, like, or comment. It helps tremendously. It'd be great to hear from you on LinkedIn. I'm super open-minded to recommendations of guests that we should have on the show, or areas of the market we should explore further. So do drop me a message. The People, Property, Place podcast is powered by Rockborn. The team recruit leadership and future leadership hires for real estate owners, funds, investors, and developers. So if you're looking to hire top talent for your business, head over to the website www.rockborn.com, where you'll be able to find a wealth of information, or feel free to drop me a message on LinkedIn. Have a great day wherever you are, and I look forward to catching you next time.